Hi guys, welcome et bienvenue on the channel. An ETF offering a 10% yield with potential for price growth too sounds too good to be true, right? But this fund actually exists, and in this video we're breaking it down. So is this a real opportunity or just another dividend trap? Let's find out. Today we're talking about WINC, a brand new income ETF from iShares named World Equity High Income Active UCITS, and see how it compares to its peers like JEPG, QYLD, and even VOO, and share why I recently shifted one part of my positions into it. This kind of asset is super interesting if you're looking for steady income, or if you're shifting from growth stock to income-focused investments, maybe for retirement, or just to build some consistent cash flow. Now the big question is, can this ETF keep delivering that 10% yield while holding its price? Or better yet, give us some growth on top of that. If it can, we're getting close to what the S&P 500 has been doing on average over the years, and honestly, I would take that any day. A quick disclaimer before we go deeper. This content is for entertainment and educational purposes only. I'm not a financial advisor, so always do your own research or speak with a pro before making investment decision. Let's dive in. So the investment objective and strategy. The fund is actively managed, not passively tracking an index. The strategy aims to generate high income plus capital growth with somewhat lower volatility than broad developed market equities. It uses for that a proprietary model approach to select stocks. It also may include derivatives like futures, call option, etc., and cash collateral as part of its strategy to generate additional income also. The use of futures S&P 500 is clear on the top exposure that we'll see after. Okay, the key characteristics. Asset under management is not huge, around 150 million USD, less compared to large passive index ETFs. The fund is recent with only 1.5 years of data at the day of this video and launched in March 2024. The base currency is in USD. The total expense ratio is 0.25% in the average of other European funds. It's based in Ireland, very classic, and listed on Euronext Amsterdam in US dollar, on Xetra in Germany in euro, and on the London Stock Exchange in British pound. The number of holdings is around 360, with a dividend distribution yield from 9 to 10% that we receive quarterly. The PER ratio is over 24, which according to the holdings data confirm that the sector exposures are heavyweight in technology. We can see big tech appear from the top holdings like Nvidia, Microsoft, Meta, all the Meg 7 in fact. And the returns. In USD, year to date, it's up 16.7%. In the last 6 months, it's also more than 16%. We can see the growth on the chart after Trump tariffs in April this year, 2025. And since inception, it's up more than 27%, where VOO, the Vanguard S&P Total Return ETF, is nearly around 33%. Not so bad at all. Now, yes, this ETF is still new, so we need more data to confirm these early numbers, but it's looking very promising. Let's talk the risk and have some observation. Because it's actively managed, the returns depend heavily on manager decisions, execution of derivative overlay, and market conditions, as always, of course. Another risk here is the currency exposure. Although the base share class is in USD, the ETF is listed in multiple currencies, British pound, euro, which introduce foreign exchange effects. And as always with covered call, the growth is capped with this asset, and the expense ratio is usually higher than an index tracking ETF, but there is no stress with managing the option trades yourself. And investing also in this kind of ETF may help reducing your portfolio volatility, and in bad market conditions, the income from the options help to offset the higher cost you can have. Okay, what about a few comparisons? I compared WINC to a global income ETF from JP Morgan, JGPI, also ticker JEPG, which I've covered here on the channel. It's probably the closest competitor on the market, and honestly, the results are pretty clear. WINC performs better when markets go up, meanwhile JEPG has been kind of stuck. There's no growth, no price action, flat chart since the last bull runs that started in April 25. Even when you put it side by side with VOO, the growth gap isn't as big as you might accept. Yeah, really, WINC shows way better growth during bull markets than JEPG or JGPI, even if there's more volatility. My take here is, as an income investor, I'm okay with lower growth than traditional ETFs as long as the NAV holds up. And that's the problem with things like SDIV or QYLD. Their income is good, but the capital gets eaten away over time. Their option strategies, for me, it's outdated. We are now seeing more way advanced and efficient strategies coming on the market. WINC, which is actively managed, seems to fit into that new wave. I used to be pretty heavy on JGPI, but I recently trimmed my position because the growth just isn't there. I'm rotating into WINC instead, a little bit for now, and I'll be adding more whenever we get dips in the market, even if it comes with a bit of more volatility on this ETF. So my conclusion, is WINC a game changer for passive income investors? Maybe. It's still early days, but the signs are promising. Better market reactions than JEPG, JGPI, good growth like US Vanguard VOO S&P ETF, and none of the capital erosion we've seen with QYLD, SYLD from Global X. That's a solid mix for me. Let me know what you think in the comments. Would you add WINC to your portfolio, or are you sticking with the classics? And hey, if you found value in this video, smash that like button, subscribe for more passive income content, and turn on notifications so you don't miss the next one. Thanks for watching. I'll see you soon. Merci beaucoup, and sorry for my bad English. Bye bye. See shifting. Shit. Not in the mood. I'm not in the mood. Yeah.